Hi guys, it's Stock Curry, and the market is starting to show some signs of bottoming out. So in today's video, I'm going to share with you how you can know when the stock has bottomed out and when it's time to buy the dip and rebuild your position. So let's get into it! Alright, as I've been saying for the past couple of months, during a bear market, stocks can fall far lower than you ever thought they would. We are seeing mega cap stocks like Netflix and Facebook fall down to levels that a lot of people never thought they would get back down to ever again. So this is just one example. And then if you look at the fundamentals, you think, okay, well, the stock should be trading at a PE of 40. It's now down to 25. It couldn't possibly go any lower. And then you buy in and it keeps going down more. Or you look at the technicals and you think, well, here's a strong technical support level that goes back 2 years. There's no way the stock is going to drop below this. And it does, and it keeps going down more. And so time and time again, whether you look at the fundamentals, the technicals, whatever, it doesn't really, it starts to fall apart in a bear market because no matter what, no matter how low you think a stock is going to go before it bottoms out, it can still go lower. So then the big question is, well, okay, if you're looking at something, you're thinking, wow, you know, this stock is really cheap fundamentally. When can I safely buy back in so that I can basically try to get the bottom as much as possible so that I'm not buying in and then watching my stock go down another 10, 20, 30% from here? Because let's face it, nobody likes to lose money. And so today I'm going to show you how you can try to find when to buy back in, when to buy the dip. Now, it's kind of a trick question that I posed as far as being able to time the bottom or know when a stock has bottomed out, because the truth is you can't. You literally cannot. But what I do want to say is this. When a stock gets down to a certain fundamental point where you say, you know what, this thing is really dirt cheap, then what I would do is I'd start dollar cost averaging in. I wouldn't load up because, as I just said, this stock could continue to go down. But what I would do is I would start dollar cost averaging in. So if a stock that you think should be at a PE of 25 is now down to a PE of 10, what you might want to do is maybe once a week or once a month, start putting some money into that stock to rebuild your position. If there's some technical level where you're like, man, this thing hasn't been this low in 2 years, and you think it's got to rebound, it's just way oversold, then I would slowly dollar cost average in. I wouldn't just load up. And the reason is because it could keep going down. Now, the question that some people have posed to me is, well, if you think it could keep going down, why not just wait? And the answer is, well, because it could go up. We are currently seeing some psychological indicators that we are near the bottom of this correction / bear market. Some indices are bear market, some indices are correction. But we are seeing some psychological indicators that are pointing to us being at least near the bottom. And some of those psychological indicators are things like every single person is bearish on the market. So people are saying, wow, you know, I just think it's going to keep going down. I'm not buying anything yet. I'm just selling at a loss because it's just going to keep going down. When everybody's bearish on the market, everybody's talking about the market going down, that's a good indicator that you're probably near the bottom. It kind of plays into Warren Buffett's old saying that when everybody else is fearful, you should be greedy. Now, the other indicator that I'm seeing is I'm starting to see some retail investors say, oh, the market's rigged, I can never make any money, I'm done, I'm getting out, I'm never getting back in the stock market ever again. And when I start seeing retail investors say that they're going to get out of the stock market, they're done, they're never going to trade ever again, that is another indicator that we are near a bottom. It's a point of panic, a point of panic selling, feeling of dread, like there's just no turnaround, things will never get better, and that's when you know you're pretty much at the bottom. So psychologically, we are seeing these indicators. Now, I do want to point out that technically, the markets are still bearish. We haven't gotten any confirmations of rebounds yet, despite last week's run-up. And speaking of last week's run-up, I want to remind you that this is a bear market. It's not like the March 2020 crash. During a market crash, and even during most corrections, you'll see the market drop for about a month, and then that's it. It bottoms out, and then over about a month or two, it'll go back up to new all-time highs. But that's not how bear markets work. In a bear market, you'll see the market drop for about 2 to 3 weeks, and then you'll see the market rise for 1 or 2 weeks, and then it'll drop for 2 or 3 weeks, then it'll rise for 1 or 2, 3 weeks, and then it'll drop for 2 or 3 weeks, and it's this stair-step downward pattern. It's not a straight line down. So just keep that in mind, that we had our 3 weeks of dropping that ran throughout most of January. Last week was a green week. This week, I don't know, we'll see what happens. But there's a good chance that this week, next week, or the week after, we're going to start going back down again. So you've got to be careful of that. Don't think that, okay, we had a green week last week, that must have been the bottom, we're going up. It doesn't work like that in a bear market. So be careful. Stocks could still fall another 10 to 15% from here. I know that sounds crazy, but it's true. We could still see stocks fall another 10 to 15% from here. So just keep that in mind and be careful. Today, I'm going to review some stocks that you might want to consider start buying the dip on. I'm going to also give you some stocks that you might want to wait on. And I think when it comes to buying the dip right now, it shouldn't be a market-wide decision. It should really be on a stock-by-stock basis. So you really have to look at each stock individually, one by one, by itself, and ask yourself, is this undervalued? Either fundamentally or technically, is it undervalued? And if you think it is, then that might be the right time to start dollar cost averaging in versus just blindly doing it, since we still have quite a few stocks that haven't actually really fallen yet. So let's talk about 4 stocks that you might want to start buying the dip on. And the first one is FB. This is Meta Platforms, formerly known as Facebook. FB just dropped below a major support level going all of the way back to January of 2020, or more than 2 years ago. Now, yesterday I talked about how I thought FB would rebound and bounce off of the $223 support level. I was actually quite surprised to see it drop again today, especially with the overall market rising 1%. It did form a doji candle on Tuesday, which is a technical signal of a reversal. It is also oversold on the RSI, with the RSI now down to 21.93. That is the lowest RSI number FB has produced since August of 2012. That's right, it's been 10 years since FB was this oversold on the RSI. The last time FB dropped that low, it rebounded for the next 2 days and finally bottomed out for good about 1 month later. Now, this drop in price has also captured the attention of Jeremy with Financial Education. Jeremy is shocked to see the forward PE ratio down to 17. Jeremy said this is a steal of a deal and named FB an easy money play for long-term investors. And the next stock we're going to talk about is GOOG. This is Alphabet, also known as Google. GOOG just gave back all of the profits from their earnings beats. Now, from a technical level, this is called filling the gap, and it's a signal that GOOG can now start going back up again. From a fundamental standpoint, Tom Nash said GOOG should be a $3,500 stock. Just keep in mind that in the short term, we are still in a bear market, so don't be surprised if GOOG continues to fall. And next up is PTON. This is Peloton. PTON is up over 50% over the past 2 days on rumors that they might get bought out by either Amazon, Apple, or Nike. But Tom Nash said PTON has risen so much over the past 2 days, retail investors have just priced PTON out of a potential takeover bid. PTON might have been looking like a good M&A target at an $8 billion market cap, but not at a $12 billion market cap. Further, analysts are saying that Amazon most likely won't buy Peloton based upon Amazon's M&A history. But Apple and Nike are still possibilities. Now, while all of that was playing out, PTON fired their CEO along with 20% of their employees. Peloton's new CEO is more of an investment banker than a CEO, and in my experience, when a company hires an investment banker as their CEO, they are doing that for the sole purpose of getting ready to sell the company. So in my mind, the rumors of a possible buyout are probably true. But as Tom now said, the buyout probably won't happen until PTON drops back down towards an $8 billion valuation. And then the market cap might jump to $12 billion once the acquisition is announced. So it's unlikely PTON will rise much further from here from a fundamental standpoint, although with enough retail traders buying the stock, anything could happen in the short term. And the last stock we're going to talk about is PYPL. This is PayPal. And this is kind of interesting. If you look at the chart on PayPal and you compare it to the chart on Meta, they're almost identical. Here's PayPal, here's Meta, here's PayPal, here's Meta. You get the drop followed by a rise and then a major drop and then a continued drop down below strong support. PYPL, you got the drop, the rise, major drop followed by a drop below major support. It's almost identical. Now, the last time I talked about PYPL, I said I thought it would drop down to $125, which is a support level that goes all the way back to July of 2019. PYPL is now trading below that long-lasting support level. Further, Jeremy with Financial Education pointed out how the forward PE is now down to 25, which is quite low for a growth stock. Jeremy also looked at how PYPL now has earnings that are more than double where it was back in 2019, and yet the stock price is below where it was in 2019. Jeremy with Financial Education said that is crazy and that the share price is super low right now. And I agree. Jeremy has been buying PYPL and building his position. I also agree that PYPL would make you for a great long-term hold at this point, given how it has now dropped down to the $125 price that I predicted it would get down to. Alright, I hope you enjoyed that video, get a lot out of it. Comment down below what your favorite stock to buy the dip on is. And I do want to remind you that we have a coaching program set up, so if you've been losing money in the stock market, if you want some help, you want to learn how to trade options, you want to learn technical analysis, you want to learn how to do some basic fundamental analysis, if you want to learn how to trade, rather than just going out and taking some trading course and, well, hopefully you learn something, maybe you do, maybe you don't, we have a coaching program set up where you have both myself as well as another coach I hired that will help you and answer any questions you have and guide you into learning how to be a successful trader in the stock market. I do want to let you know that I just hired another coach. His name is Steven, and he is a very successful trader. He's been trading in the stock market for about 8 years, been trading options for about 4 years. He's got a 6-figure portfolio, has been profitable for years, and he is over in the Discord helping out as well as myself. So if you're interested in that, you want to get some coaching, I do have a discount for coaching right now. You get $5 off. You can sign up for that or at least check it out over at stockcurry.vip/coaching. That's stockcurry.vip/coaching. And if you're looking for a broker to trade with, Webull has a promotion going right now where if you sign up using my link in the description below and you deposit just $1, Webull's going to send you 3 free stocks worth up to $3,300. Also, when you make your first crypto trade, you get $5 in free crypto. Now, if you're not a U.S. resident or if you're looking to trade OTC penny stocks, then I recommend Interactive Brokers. Interactive Brokers is a highly discounted trading platform. Trades start at just $1 US, $1 Canadian dollar, 4 euros, or 6 Australian dollars, depending upon where you live. And both Webull and Interactive Brokers both offer the full pre-market and after-hours trading from 4 a.m. until 8 p.m. Eastern Time. Now, I do want to remind you that I have material connections with both of those, so whenever you sign up for either one, not only are you getting a great broker to trade with, you're also helping me to continue to produce these great videos for you. Now, finally, I want to remind you to hit that like button, subscribe, and follow the page if you haven't already. I hope you have a lot of success trading, and I will see you tomorrow.